Yo, 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 what's the dealio, man? Listen, you already know I got a straight banger for you today, all right? Now listen, in this video, what I want to talk about, we're going to go over a lesson, all right? I'm going to help you make more money and also not lose as much money, okay? So we're going to talk about how to play earnings, okay? The best way how to play earnings, all right? And we're going to talk about implied volatility, okay? Implied volatility. And what about implied volatility? It's something called IV crush. So I want to break this down for you. I don't want to make this a complicated thing, a complicated concept. I want to break this down for you in simplistic terms so you could understand why you should not trade earnings before the earnings report comes out. All right. So if you're just tuning in, be sure to like this video for me. Subscribe to the channel. We are almost at 2,000 subscribers. Once we hit 2K, I got a couple things that I want to do. All right. So be sure to subscribe to the channel. So let's get into it. Now, before we talk about implied volatility, I want you to understand that you have every quarter, each stock reports earnings, right? When they report earnings, what happens is they're basically talking about their revenue and how the company is doing, right? And what ends up happening is the stock usually goes up or it goes down. Okay, good earnings or bad earnings. Now, a stock could go up if it has bad earnings, and it could go down if it has good earnings, and vice versa. So you really don't know what's going to happen, right? There may be some traders that have this system down that they know what's going to happen and know which stocks to trade before earnings, but a lot of the times you don't know what's going to happen. All right. So with that being said, now let's talk about the implied volatility. I want you to think about implied volatility like, let's say you and a friend are talking, right? You and a friend are talking and they're like, yo, I got this car. Okay. This car is fire. I want you to see this car. It goes really, really, really fast, right? So if this person is hyping this car up and hyping this car up and hyping this car up, you're going to expect the car to go fast, right? So this is the implied volatility. So your expectation is what you have in your mind. So that's what implied volatility is. It's basically an expected move, okay? So let's say the next day you go kick it with the friend and you get in the car and the car don't even go fast at all. And you're like, man, this was BS. That's the same thing that happens with earnings and implied volatility, right? I hope that makes sense and I was able to simplify that, right? So let's go to the stock market and really understand this a little bit more. When you have expected move based on the implied volatility, right? If the stock doesn't move what it's expected to, you're gonna lose money. I've done it before. I've got into a contract before earnings. I remember last year I got into Nvidia, right? Before earnings. So they had earnings after close. I got in right before, okay? Now, I got in the call. It wasn't even out of the money either. It was at the money. And what ended up happening was the stock went up by like $3. And I was like, damn, why did it only go up $3? But I was like, it's all good. When the market opens, I'll just take the profits. The market opens the next day and I'm down in my trade, but the stock went up. And I'm like, what is going on here? That was IV crush, right? My implied volatility got crushed and I got played. And so all the time people think that, oh, the stock is about to go up. I'm about to get into a call before earnings. No, you don't know that. You don't know what the expected move is. You got to have this stuff down to a science. So what you want to do instead is you want to be like, you know what? I'm going to wait until the stock market closes. I'm going to see what the stock does after earnings. And then what I'm going to do is I'm going to trade the stock based off of that. Now, let me give you something else as well. The week of earnings, the premiums on that contract for that week's contracts goes up, right? It goes up. So if it goes up, that means that you're paying about 10 to 30% more than what you need to be for those same contracts a week before. Those contracts were not trading for what they're trading right now, right? So let me give you guys some examples. Let's go look at Webull. the options chain, and let's go look at it, okay? So what I'm gonna do is, I'm gonna do this, all right? So let's look at this real quick. So we have, I wanna look at the earnings first, okay? So look at this, y'all. So here's the earnings calendar, all right? So we got Waste Management, so tomorrow, all right, before the market opens, we got PayPal, Boeing, SoFi, UNH, all right? We got Visa, we got Mara, okay? So let's go look at SoFi's contracts since they have earnings tomorrow. SoFi, their contracts are like $100, $80. These same contracts are usually $40 to $60 at the money, right? Right in the money. They're usually about 15% less, right? Because earnings is tomorrow. Let's look at Boeing, BA, right? Look at their contracts for between $490 and $520 right at the money, or $600 to $650, right? What this is if we didn't have earnings this week, Boeing, these contracts would be $200 to $300. So they're double the cost. When I was saying 10 to 30%, I was being very modest, right? But let's go a little bit further. Let's look at Meta, okay? Let's look at Meta. That's a popular ticker. We go to Meta, META. Look at these contracts. The contracts are $2,000. $2,000. Now, if it was a regular Monday, those same contracts would be trading with, if they did not have earnings, those same contracts would be $1,100, $1,200, $900. They're double the price. So you're exposing yourself to more risk than you need to be, right? Let's keep going. Let's look at Microsoft, Apple, and Amazon. Microsoft contracts is $1,000. Last week on a Monday, those same contracts were $400 to $500. So double the price, right? Where's Apple at? Apple's contracts, $385 to $500. Usually they'd be $200, $250, right? Let's look at Amazon. Okay, $500 to $600 when usually they're $200, maybe $300 per contract. I'm not gonna pay double the price just to trade a stock for a name, right? I'm just gonna wait till the dust settles, let the premiums fizzle out, and then trade the stock when the price comes back down. Because here's the crazy part, right? You can always trade different stocks. Just trade stocks that don't have earnings that week. That's all you got to do, right? That's all you got to do. And let's look at Hood, because their contracts are usually under $200. Look, $500, $500 to $600. These contracts are always less than $200. So why would I trade a stock, right? Why would I trade a stock 2.5x the premium price, the contract price, because they have earnings? All I got to do is wait for 3 days, and then I could go back to trading that stock, right? That's all you got to do. So I want you to understand what's happening here, right? Don't trade earnings. Also, leading up to earnings, you don't have to trade that stock until they have earnings. You can, but you're just going to pay more than you need to. I don't trade stocks that have earnings until they have the earnings report come out, right? Now, what you could do is, let's say a stock has earnings a month and a half from now. What you could do is, and let's say the stock is down right now, you could say, you know what? I'm going to get a swing trade. I'm going to swing this stock. And what I'm going to do is I am going to get an expiration date of the week that the stock has earnings, right? Because if you know that those contracts get inflated, right, then what you could do is you could benefit from the inflation of those actual contracts, right? And then you could sell as that date gets closer, because those contracts are starting to go up in price. Not value, but price, right? So I want you guys to think about that. So that's what happens with implied volatility, right? You have an expected move, right? Somebody been hyping up a car or hyping up something, and you were like, all right, I'm expecting the hype I'm expecting this thing to live up to the hype. So everybody gets calls. Everybody thinks that the stock is going to go up by $20 overnight. And then what happens? It only goes up by $8. So the stock went up, but it didn't go up by its expected amount. And so what happens is that's a disappointment. And because that's a disappointment, the contracts actually lose value, right? So instead of doing that, just wait until the stock has earnings. The next day, look in pre-market, look at the levels and trade the stock based on the levels. It's that simple. All right. So listen, that's what I wanted to talk about today. That is a lesson. That is a gem, right? If you apply this right here, you'll save more money. You won't lose as much. You'll make more money and you'll be less stressed. All right. I know sometimes you have FOMO and you be like, I'm going to do a YOLO contract, but it's like, what if you just waited one day, 12 hours, 18 hours, right? Be disciplined, manage your risk. And when you see a clear direction, then you could trade that stock. And what you thought you missed out on, you could actually make that same amount of money or more because that stock is actually going into the direction with momentum and you're not paying an inflated cost for the premiums. All right. So I hope that made sense and I hope that helped you. All right. So listen, it's Monday. It was a good start to the Monday. All right. We hit Dale. And so we swinging them right now. So listen, we got a whole week to go. We got 4 days left. Let's make the best of it. All right. So I want you to say it with me. Get out of your head and go get into this world because your head is a dangerous place to live. All right. And also remember, the more you study, the less you worry. All right. I'm going to see you guys on the next video. Peace.